Welcome to Business Nigeria, and I am Tunji Andrews. Another quick look at the news relevant in the business and financial world. The Central Bank of Nigeria has said that it might delicense 3 banks. These banks were found to be short of the minimum 10% capital adequacy rate once the Treasury single account was implemented. The banks have been notified and have till June 2016 to recapitalize. Also, Sterling Bank has secured a $40 million facility from the Turkey Exim Bank. The bank plans to use the facility to support businesses and projects with Turkish origin. And on the softer note, EcoBank Nigeria has unveiled an online marketplace, mymall.com.ng. The platform will host SMEs who do not have the funding to build an e-commerce platform. Now, quite similar to what we have with Alibaba and Amazon doing, which are still thriving also. Now, moving away from that, we'll also be following that as concerns Black Friday too. Now, still on economic matters, the Monetary Policy Committee will wrap up its 247th meeting in Abuja tomorrow. The meeting, of course, kicked off earlier today. Some of the decisions to look out for will include effects of the single treasury account policy on banks and possible adjustment to CRR for private and public fund deposits. Updates also on the effects of the sharp fall in crude oil prices and perhaps a review of the domiciliary account policy. Now, joining me for that discussion is Kayode Akindele. He's a director at TIA Capital. But first, Tosi, will you take us through what we've seen year to date as concerns the MPC, GDP, and the rest?
Tunji, let me take a quick look at the MPC review. This is the 6th and last MPC meeting in the year 2015. But before I delve into what we think the outcome is going to be, let's take a quick look as to how the policies fared during the year. In January, the MPC unanimously retained the rates from the prior meeting. That is, MPR was left at 13%, liquidity ratio was left at 30%, and the CRR on private sector was 20%, while that of the public sector was 75%. However, in March, the rate was also held as the committee felt that they have not had enough time for the policy to kick in, and as a result, they left the rates unchanged. In May, the MPR yet again was retained at 13%, likewise the liquidity ratio. However, there was a harmonization of the CRR on both the public and private sector to 31%. We could see a lift on the stock market then, and even just the liquidity ratio when this news hit the market. That was in May. In July, all the policies decided on in May were left unchanged. Now, let's take a look at how September fared. September, the CRR was reduced from 31% to 25%. That is, it lost about 600 basis points. 7 people voted for this to happen, while 3 people voted against it. This also happened to coincide with the news hitting the market about the TSA. You know, the implementation on TSA, which we've actually finally seen fall into place, happened. And we also see that the CRR was not enough to negate the outflow that we saw from the TSA. Also, the MPR yet again was held unchanged, that is at 13%. Let's take a quick look as to how the MPC fared on the different parts of the continent. South Africa has seen a contracting GDP growth, and also its currency has been under so much pressure, currently trading at 13 rand 80 cents to the dollar. MPC hiked its rate by about 25 basis points. We also see that of Ghana. Yet again, just like Nigeria, Ghana is experiencing a slowing GDP, and also one of the worst performing currency on the continent. It increased its MPR by 100 basis points to 26%. Kenya left its rates unchanged. So now back to the MPC on the continent. What is the question? The question now is, number one, are we going to drop the rates? Are we going to see lower market and lending rates, or are the rates going to be left unchanged? There are divergent views across the sector. I mean, based on the different macroeconomic indicators, considering that we're also seeing a slowing GDP rate, we've seen inflation also. I mean, this year, inflation dropped just once, while it stayed stagnant once. However, there's been a steady climb in inflation. We also see the USD and Naira average 197 to 199 on the market. But now, Chapel Hill thinks that they're going to drop rates by between 100 to 200 basis points, while Afrin Invest thinks that the committee members are most likely going to leave the rates unchanged. So what do you think is going to happen?
Thank you very much, Tosi. Now, like I said, joining me on the platform, we have Kayode Akindele. He's a director at TIA Capital. Let's just imagine that this is Abuja, and this is the CBN Towers, and you're deliberating. What would you say to do as concerns the rate for MPR and CRR?
I think they're constrained on what you can do. If you look at rumors about 2016 budget, there's rumors going to be very expansionary. The expansion budget, the government is going to increase its borrowing. Increases borrowing, needs liquidity in the banks for that borrowing. And what we're seeing now, the banks are very liquid. And it seems to be a deliberate policy by CBN. Not only did they reduce CRR, they stopped their OMO operations, which is giving the banks quite a lot of liquidity. And it seems to me as if they're preparing themselves for 2016 and preparing the banks for that. So I'm not sure they're going to do anything. I think, look, MPR, inflation seems to have come down a bit, especially food, and so that's helped them. CRR has put liquidity in the system, but they don't want to put any more, because already it's quite liquid. So I don't think they're going to do that much.
Over the weekend, the CBN governor was quoted saying Nigerians should patronize made in Nigeria goods. I mean, he's talking about the fact that we should try to do that to try and ease some of the pressure on the foreign reserves. I'm now wondering, do you think this would lead to more capital controls? There are still rumors going around. Sarah Alade had to come out to debunk one of those rumors last week. Do you think there's any truth to it?
I understand what the CBN governor is trying to do, but you can't force Nigerians to buy made in Nigerian goods if made in Nigerian goods are not available. Now, we have manufacturers complaining that they don't have enough forex to actually buy raw materials to actually produce. And we're looking at manufacturing, and manufacturing is contracting. So you have to try not to throw the baby out with the bathwater. Because you have a process where, yes, you try and control demand of forex, but you need that forex for a lot of the raw materials. We do not make machinery for a lot of the manufacturing in this country. We have to import that. But manufacturers can't get access to that. And I think in the process, I can understand where CBN is saying that a lot of the demand is contrived. And they're trying to do that. Because if you look at what happened in the broad exchange market, all of a sudden they introduced BVN and tell people that all transactions have to be through BVN. All of a sudden, people stop going to the broad exchange market and start going to the parallel market. Now, parallel markets demand, the price has gone. Now, is that true demand, or is that because people have shifted in that process? And if you had the free-floating exchange rates, that would have affected
People have said we should close the market completely. Do you think, as the whole FX regime as a whole, would we see any changes?
There have to be changes. I think the process, as we see it right now, is not working. Those who need Forex aren't able to get it, at least not at an affordable rate. You've been able to maintain this artificial exchange rate in terms of process, but it's a very short-term thing. I think the Vice President has mentioned that, CBN has alluded to that. It's very short-term. At one point in time, you're going to have to let go of those buffers and find the natural rates of exchange.
Now, so much money in the economy. Over 1 trillion in terms of liquidity. And we're still having that discussion. First time in history where no, maybe not first time, but I'm beginning to hear the same narrative you hear in Europe, where the government and the reserves is trying to incentivize banks to lend. It's quite amazing. But for small businesses, the kind of liquidity we're seeing in the economy, analysts are still saying that we might see CRR cut again, which would increase the liquidity in the economy. I mean, what do you think, first of all, how do you think that will affect banks in terms of lending, their disposition to lending? And also, how do you think this is going to affect businesses?
The biggest problem Nigerian banks have, to be honest with you, they don't know how to lend. If you look at the whole credit, it's improved since 2008-2009 crisis, when Governor Sanusi came in with his reforms. It has improved, but not enough, because if you look at NPLs of banks right now, they seem to be going haywire. And it shows that the whole credit process, even some of the bigger banks, if you look at some of the NPLs and some of the deals and their exposures, they seem to be overexposed in certain sectors, which they shouldn't be. So I think the biggest problem is not lack of liquidity, it's how to lend. Then the banks will argue there's structural issues. We don't have power. Each bank branch has to have power, their own lights, their own water. Those are structural issues.
Inverters.
Exactly. Those are structural issues which increase the cost of actually doing business. And until you address those issues, you're going to have those kind of problems. And secondly, we can't identify our customers. Now, we have this BVN, which will help in the process. But onto BVN, it made sense for the banks to go for the big, larger borrowers, because at least you can identify them, you can identify their assets, you can identify who they are. SMEs, someone can give you an address, you can't track them down. And that's the kind of problems they had. So I think as you start to address those problems, then you can see the rates will come down, the risk premium will come down, and then you start trying to lend to the real sector.
We were looking at this last week, and we saw that GDP numbers showed that some sectors were already in recession. There have been predictions about the economy as a whole going into recession from about Q1, Q2 next year. Do you think that that prediction is still on course?
Yes, unless, I mean, the onus is on the 2016 budget. We need a new ministerial team to go in place and actually just, the economy is a shock. I need to bring out some policies, bring money into the system, a situation where the petrol queues have come back, where you have fluctuating power supply. There was an improvement in the summer, it now seems to have gone down to a certain rate. All that affects the cost of doing business and doesn't help. The productivity we're losing from those petrol queues and all the traffic alone, that's affecting the economy.
That's affecting, yeah.
And until we sort that out, and I think the government has to make some really hard decisions. Do we need a petrol subsidy? Because we can't be having it every 2 or 3 months, a situation where the economy is now slowing down because of a lack of petrol. Let's address that issue. I'm sure most people outside Lagos and Abuja have not bought petrol at 87 naira for months.
True.
And so what's the point of having a subsidy if that's the case?
Well, you've heard it. We have been speaking with Kayode Akindele, he's a director at TIA Capital, and we're talking about Nigeria as concerns the MPC. They are holding their meeting today and tomorrow, and they will be coming out with their findings at about 2:15. You can watch that broadcast live on the Apex Bank's website. I think that's www.cbn.gov.ng. And basically, we would also be following the analysis because we'll be giving you a bit of robust analysis tomorrow. Thank you for being with us on the show. It was such a pleasure having you. Now, keep it locked on BTVA for all your premium business and financial coverage. Till tomorrow, it's Business Nigeria, and I am Tunji Andrews. Keep doing business, Nigeria.